Welcome, everybody, and thank you for joining us for this month's version of Team LWC's investor presentation. We've titled this presentation In Between a Rock and a Hard Place. The reason we've chosen that is because the precarious position that central banks around the world find themselves in, with falling earnings, a weakening economic backdrop, without the ability to cut interest rates. Typically, in these periods of economic weakness, the Fed and the Bank of Canada have the liberty of cutting interest rates to be able to support the economy. You saw that take place in 2020 during the pandemic, which is highlighted here in the bottom left chart. You saw it also in the great financial crisis back in 2007. In this particular situation, it's unlikely that the Fed will pivot its stance from hawkish to dovish. Before I move forward, for all of those that maybe are seeing those terms but not overly familiar with what it means, a hawkish Fed or Bank of Canada is one that's raising rates, and a dovish one is one that's cutting them or utilizing easy monetary policy. Inflation has begun to abate, albeit still roaring pretty hot from what we've experienced over the past several decades. But we are seeing easing and likely see more easing as we move into Q1 of next year, where energy prices really had spiked and cascade through the economy. Headline inflation is something that obviously doesn't capture everything, and where the Bank of Canada and the U.S. Federal Reserve may pivot their rationale for remaining hawkish is on the backs of strength in the labor market. The labor market accounts for a massive part of GDP, as many of you business owners would know, or anyone that's built a house. A big part of that are those labor costs. And without labor, the labor market easing, it's challenging for the Fed to pivot their overall stance because they could get it wrong, take the foot off the gas too early. Inflation rear its ugly head once again, and it just draws out this longer process. So unfortunately for that stance, it's likely that we need to see a bit of pain in the labor market to be able to pivot to a more dovish Bank of Canada or central bank. However, in an earlier press release this month, Jerome Powell did say that a substantial majority of the participants in his committee have judged that a slowing pace of interest rates would likely be appropriate in the near future. That brought down kind of the expectations of where the Fed fund rates goes. That's what you can see in the chart on the top right here, with that gray bar below the blue bar moving lower, while still expecting rate hikes up until the middle of about next year, peaking out at around 5%. But where we're focused on and looking at is the labor market, and we're starting to see some signs of it. People often focus and put too much attention on the unemployment rate, the headline unemployment rate, which still sits at a fairly low level. However, we focus more on real-time data like payrolls data or the number of U.S. job openings, which we saw decline 3.3% in the month of October, and also looking at the unemployed persons per job rates, which fell over 8% last month. Unemployment is actually likely going to be a buy signal for the equity markets once we start to see that rolling over, and that weakness coming through is when we'd expect that pause from the Fed or the Bank of Canada. And it's more of a pause that we're looking for. We think that they'll take some time at that neutral rate to be able to determine if the effects of the interest rate hikes are taking place and having the impact that they desired. Another labor market statistic that we watch closely is the quit rate. You can see that in the chart in the bottom left, the blue line, which is rolling lower. The quit rate, people tend to quit their job in favor of a newer, higher paying job, which obviously causes wage price inflation, which can cascade through the economy, and it's one of the things that the Fed is actually trying to abate. And so with the quit rate falling, that's giving us insight that future wage growth is likely to be lower than it is as of today. And we have seen already major job layoffs from some of the large mega cap tech companies like Twitter, Amazon, Meta, just to name a few. But demand for workers, largely speaking, still remains high, with job openings dropping slower than the rise in unemployment, meaning that it's still possible to find a job if you lost your current job. But we believe that once we see this weakness take place, it's likely that there'll be an end of the rate hiking regime, and that don't fight the Fed mantra that everyone talks about is going to be behind us. We are experiencing another really strong month in November, following a strong month in October. So we are in a rally mode right now. Whether this is a bear market rally or the start of the next cycle is still to be determined in the future. And we are constantly monitoring and overseeing all of your portfolios on a day-to-day basis. And I'll talk about one of the position changes we made to take advantage of the current environment that we find ourselves in today. I'd reiterate that we tend to take a barbelled approach, looking for defense within our defensive investments and offense within our offensive investments, or our more risky investments. And so with that in mind, we're actually kind of dialing back risk a little bit in the fixed income component of our portfolio by exiting our position in the preferred share market in favor of corporate bonds. Both equity and fixed income markets are forward-looking instruments. And this is an important point to drill down in these conversations, because a lot of people focus on the economy and, hear that we may be rolling into a recession in the start of next year, or could all potentially already be in one. But the corporate bond market is already predicting a bit of that economic weakness. The average bond in the aggregate FTSE DEX bond index is trading about 88 cents on the dollar, which is already in a way pricing in a light recession. And so whether that happens doesn't necessarily impact the fixed income market. It's whether we get through it in a efficient and timely manner, which we believe is our baseline expectation. In such a case, you would likely see these bonds drip back to par, giving capital appreciation for bondholders along the way. Another reason we are making the trade is that we formerly had to chase yield in a way in the preferred share market, as fixed income did not pay very much. That has now changed, and the product that we're moving into supports a 6.4% yield. And also with our baseline expectation that you would still see bond yields continue to rise, the short duration of just 2 years helps provide a bit of protection on that sense. And then lastly, part of the reason of the trade out of preferred shares is just some of the inefficiencies that we were in there for before from a market dynamic standpoint, with the advent of new instruments for banks to use, has kind of faded away. And so that's where we stand today, and wanted to wrap things up here and just let you all know that these are the type of changes that we're doing on an ongoing basis, continuing to play offense and defense at the same time while overseeing your wealth on an ongoing daily basis.